ICC Wealth and Capital Market Summit here in Calcutta. We'll be starting the session with the inaugural lamp lighting. May I request Mr. Atanu Sen, Dr. Amarjit Singh, Mr. Chalasani, Mr. Krishnan, Mr. Vijay Darak, Anindopal Chaudhuri, and the distinguished speakers in the front row to please come, and I'll request all the speakers to come forward and join us in the lamp lighting. I'd now like to call on stage for starting our inaugural session. I'd like to start with Mr. Atanu Sen, ICC National Committee Chairman, BFSI. He is also in the boards of Tata and Bandhan Group of companies, and he is also the former MD and CEO of SBI Life Insurance and former chairman of NPS Trust PFRDA. Welcome, sir. I'd now like to call upon stage Shri Amarjit Singh, whole-time member, Securities and Exchange Board of India, SEBI. I'd now like to call upon Mr. Venkat N. Chalasani, CEO of Association of Mutual Funds in India, AMFI. Mr. Shashi Krishnan, Director, National Institute of Security Markets, NISM. And last but not the least, our own Dr. Rajiv Singh, Director General, Indian Chamber of Commerce. Thank you, gentlemen. We are very honored and privileged to have the regulators in between us and also a galaxy of speakers who will be speaking, deliberating on various aspects of wealth and capital markets today. It will be a very interesting day. People have called that there is some traffic jam. They're coming in slowly, but we'll have to start our session because of the time constraints. So I'll now request Mr. Atanu Sen to kindly come forward, deliver the welcome address along with setting the context for today's conference. Over to you, Mr. Sen.
Thank you, Shantan. Good morning. I welcome Mr. Amarjit Singh, whole-time member, SEBI, Mr. Venkat Chalasani, CEO of AMFI, Mr. Shashi Krishnan, Director, NISM, National Institute of Securities Management, Dr. Rajiv Singh, Director General, ICC. Good morning again, distinguished guests, ladies and gentlemen, it is my pleasure and honor to welcome you all in this program today. On behalf of Indian Chamber of Commerce, I would like to thank you all for making it convenient in today's program. As you are all aware, India today stands at the intersection of confidence and opportunity. The aspiration of sustaining an approximately 8% GDP growth trajectory is not merely a macroeconomic target, it represents a larger national ambition to build an economy that is investment-led, and not only investment-led, innovation-driven, financially inclusive, which is very, very important, and globally competitive for a Viksit Bharat by 2047. Indian economy definitely is one of the fastest growing economies in the world, driven primarily by private consumption. Already one of the world's major economy, it is. The nation is charting a confident course towards becoming the third largest by 2030, with GDP projected to exceed $7 trillion. This is despite, we all know, rising global tension and the economic fallout due to the Middle East crisis. Therefore, the ambition of sustaining such a growth trajectory brings with it both opportunity and responsibility, as well as governance issues. The World Bank has projected a robust 6.4% growth rate for the country, even as the global economy faces this mounting uncertainty, which is testing global resilience and disrupting energy supply. Even today, the prices of petrol and diesel has gone up by, it has to, the pass-through mechanism has to be there. The Indian government and the RBI is taking ample measures to mitigate the effects of the crisis. Given that India has a large and has well-diversified economic structure, which can help it to strengthen its ability, and we believe it can, to absorb the external shocks. Structurally, India's growth has been robust, supported by strong domestic fundamentals. The wealth and capital markets ecosystem has emerged as one of the strongest pillars supporting India's economic transformation. So over the last decade, we have witnessed a remarkable deepening of financial participation across the country. From the rapid expansion of retail investing and the SIP culture to the increasing sophistication of institutional capital and alternative investments, India's financial architecture is evolving with extraordinary momentum. At the same time, the sector is navigating a world shaped by volatility, geo-risk, as I was mentioning, tech disruption, cybersecurity risks, changing investor expectations, and shifting global capital flows. FIIs are moving out. Therefore, conversations such as the ones we will have today are not only relevant, they are extremely essential. One of the central themes of this summit is the role of mutual funds and institutional capital as the bedrock of macroeconomic stability in a high-growth economy. As India scales, the quality and stability of domestic capital will become increasingly important. Foreign capital is important, but again, I reiterate, strong domestic participation can cushion external shocks, improve market depth, and support long-term infra and enterprise creation. Mutual funds and institutional investors together form a stabilizing force that strengthens investor confidence and economic continuity. Household financialization is accelerating. Mutual fund, as I understand, is the patient capital for long-term growth and depth. Therefore, equally significant is India's growing potential as an offshore financial and investment hub, capable of delivering global standards for both Indian and international investors. India is no longer viewed only as a destination for capital. It is increasingly becoming a center for financial expertise, tech-led services, compliance excellence, and investment innovation. Now, let us understand what is GIFT City. Many of you are aware what it is, established and the maturity of GIFT City. It is basically a free trade zone with various tax incentives, fully integrated with best-in-class infra, connectivity, people, tech, and legal framework. It has come up near Gandhinagar, you are well aware, Stock exchange in GIFT City have achieved single-day highest volumes of close to $25 billion, can become very, very significant as global financial center. The International Financial Service Center, April 2020, it is a unified regulator. Many of you are aware, may not be aware, for SEBI, RBI, IRDI, insurance regulator, PFRDA, the pension regulator, and of course the IFSCA, which is the International Financial Service Center Authority. IFSC unit is a non-resident under exchange control, deals in freely convertible foreign currency, 1,100 entities as of December 2025, 34 banks, fund management 194 of them, leasing 37 companies, insurance 52 companies, and many, many more. It is basically a conglomerate of the domestic area and the SEZ 2005, IT Act 61, and also no GST to other IFSC units. So we need to take a look at this, and GIFT City will, of course, bring us closer and integrate us to the global financial community. Wealth creation today, therefore, is being redefined by data intelligence, AI-enabled advisory models, hyper-personalized investment strategies, and access to emerging asset classes. Private markets are attracting greater interest, family offices are becoming more sophisticated, and investors are seeking differentiated opportunities that combine growth with long-term value creation. As this evolution unfolds, technology will continue to remain both an enabler and a responsibility. Rapid evolution and disruption by technology harness the power of technology. We need to do that. As we commence today's session, we must remind ourselves that wealth management is no longer merely about growing our money, it is about growing responsibilities. Responsibilities towards families, towards society, and towards the India growth story that each of us we need to play a part. The summit will also delve into the alpha edge, the wealth management part of it, the tech innovation and private markets, recognizing the rapid transformation underway in the wealth management ecosystem. Therefore, tech is reshaping how wealth is advised, managed, and distributed, while private markets are increasingly becoming an essential component of diversified portfolios. Even as markets remain unpredictable, Indian investors do not seem to be losing faith in mutual funds. I come back to that. Instead of pulling back, many continued investing steadily, helping the industry begin the new financial year on a strong note. India's mutual fund industry recorded total net inflows of rupees 3.22 lakh crores in April 2026, while overall assets under management AUM climbed to a record close to rupees 83 lakh crores, according to the latest monthly data released by the AMFI. I again reiterate, as India charts its path towards becoming a multi-trillion-dollar economy, the role of wealth and capital markets will be central to sustaining momentum, fostering innovation, and building economic resilience. The summit today will try to provide a timely and meaningful platform to reflect on these evolving dynamics and collectively define the strategies that will shape the future of India's financial ecosystem in an area of accelerated growth. The Indian Chamber of Commerce is committed to convene dialogue, catalyze innovation, and champion collaboration. We recognize that the financial sector is not an isolated domain. It is deeply intertwined in the aspirations of entrepreneurs, the savings of households, and the confidence of global investors. The strategies we craft here must therefore be holistic, inclusive, and globally aligned. I hope today's session will help bridge insights between wealth managers and investors. Let us use this forum to share experiences, debate ideas, and craft strategies that are both profitable and purposeful. Today, we can identify frameworks that will drive the next phase of India's financial growth story. Against this backdrop, ICC is organizing the 18th ICC Wealth and Capital Markets Summit to bring together policymakers, regulators, FIs, wealth managers, asset managers, fintech innovators, family offices, and industry leaders and deliberate on the future architecture of India's financial growth story. With these few words, I once again welcome all our eminent guests here and speakers and look forward to fruitful deliberations and interactions. Thank you all.
Thank you so much, Mr. Sen, for setting the tone and welcoming all the delegates. I'm happy to announce that this entire session will be streaming live on X, YouTube, and LinkedIn of Indian Chamber of Commerce. If you want to follow or refer that to any of your colleagues, you may please do that. Thank you. And now I'll request Sri Amarjit Singh, whole-time member, Securities and Exchange Board of India, SEBI, to kindly come forward and deliver the keynote address. Over to you.
A very good morning to all of you. Thanks for coming in on a Saturday morning. And as Mr. Sen said, I think gradually the hall will fill up, and it's already happening. But nonetheless, dignitaries on the dais, esteemed speakers, my colleagues from SEBI ERO, my regional head Vikas, and ladies and gentlemen, it's a pleasure to be here. And I thank ICC for inviting me, and more importantly, organizing this capital market wealth management related summit in Calcutta. Lot of similar events happen in Mumbai, and we do get to attend a good number of them. But it's important that, these events are also held in the other important cities of the country. Capital market should not, that's my personal belief, should not just be Western India centric or should not be Mumbai centric. It should actually percolate down, and more people should be able to take benefit from the capital markets. The way they have evolved, they've presented a tremendous opportunity for wealth creation. And that's where, this event also becomes more relevant. So let me, come to the formal part of my address. So the main themes of this summit is the $7 trillion economy and staring at 8.2% GDP. It well captures the scale of our ambition, India's ambition. But what does it mean at a practical level, especially from the capital markets perspective? Larger and faster growing economy will of course need long-term and patient capital, as Mr. Sen very rightly mentioned, for financing infrastructure, financing growth, financing innovation, financing urban transformation, and so on. And that's where the efficient capital markets are key to this ambition of $7 trillion economy going forward. Mutual funds, portfolio managers, and alternative investment funds. These are three areas which SEBI keeps an oversight and was also responsible for developing this space. They are very important constituents of the ecosystem, and their role goes beyond just simply managing money. It goes beyond to responsible capital allocation and widening participation in market-linked wealth creation. As I mentioned, markets offer a tremendous opportunity for wealth creation. So in my remarks today, I will primarily focus on two aspects. One would be the mutual funds, and second would be the, to some extent, portfolio management. First, I'll touch upon some key industry trends in both the spaces, mutual fund as well as PMS. Then I would like to mention some recent initiatives taken by SEBI, and finally reflect on some key enablers for orderly growth of the industry. So Let me start with some key trends, and they are very interesting trends. So, as many of you would know, over the past decade, India has witnessed significant financialization with household savings increasingly being channeled into capital markets. And there's a lot of data points to suggest that. This is reflected in the rapid growth of the demat accounts. I'm picking two data points. One is from the SEBI's perspective, from securities markets perspective. One is the growth of demat accounts, and second is the assets managed by the fund management industry. So mutual funds have been central to this transformation. Mutual fund industry today serves over 6 crore unique investors with total assets under management of over rupees 81.9 lakh crores as on April 30, 2026. The rise of systematic investing is one of the strongest indicator of changing household behavior. As of April 30, 2026, there are over 10 crore SIP accounts with SIP AUM of over INR 16.85 lakh crores. So these numbers tell you a story. They reflect on the financial discipline, long-term thinking, and growing integration. And I want to emphasize upon the integration piece of capital market participation into everyday financial planning. And that's what all the stakeholders in the system, including SEBI, have been working towards over last so many years. In fact, despite the recent geopolitical headwinds, SIP flows have remained resilient in the months of March and April 2026 at INR 32,000 odd crore for March and INR 31,000 odd crore for the month of April. So this is quite remarkable. Another noteworthy aspect is the stability part, the stability of the AUM in long-term oriented schemes. So for instance, in equity schemes, over 56% of AUM remains invested for over 24 months. So people are taking a long-term view. This reflects the growing trust in mutual funds as a reliable investment vehicle. The geographical mix also shows encouraging signs. The share of AUM from beyond 30 cities as a percentage of total AUM has increased from almost 16% to over 18% in the past 5 years. One could argue this growth could be better, but still nonetheless it is showing an improvement. The state of West Bengal contributes 4.8% to the total industry AUM, while the city of Calcutta alone is amongst the top 5 cities by AUM. So if I go by these numbers, I would have expected more people in the hall, but I'm sure people are joining online as well. The PMS industry has also seen strong growth. Over the past decade, the total assets managed by portfolio managers has grown from INR 10.4 lakh crore to INR 41.4 lakh crore at a CAGR of around 15%. Client growth in this segment of PMS also stands out. The total number of clients is now around 2.16 lakhs. Discretionary PMS continues to be the anchor of the industry, accounting for nearly 85% of assets. We made good progress as these numbers very clearly reflect that. However, to realize the ambition of becoming a $7 trillion economy, the fund management industry will of course have to grow further and both in scale and depth. The opportunity is to manage larger pool of capital while making market participation more broad-based and accessible across geographies. Let me now come to the second part of my address, just to give you some sense of the regulatory developments in the recent past. So let me, give you our regulatory approach as in the last few years. Our approach, of course, first mandate which is given to us by our Act, SEBI Act, is we have to protect the interest of investors. That is, of course, the first objective. But we are also trying to see how we can enable growth through regulations. So can we remove the bottlenecks? Can we improve ease of doing business? Can we improve ease of investing so that the industry can grow further while keeping a sharp eye at the same time on risk management, on investor protection? So in that spirit, in the mutual fund space, we've recently undertaken a comprehensive review and redrafting of regulations towards improving clarity, coherence, and effectiveness. So over time, some inconsistency do creep up. So we've dealt with all of that in the recent rewriting of the mutual fund regulations, and the number of pages and the number of words have substantially gone down. In the PMS space, the portfolio management space, we are undertaking a similar comprehensive review in very close interaction with the industry. Now we have, just like AMFI, Mr. Venkat is here, we also have now APMI, Association of Portfolio Managers, and they are aspiring, they have huge aspirations to grow further. They are in close contact with us, and we are seeing how we can do a bit of re-engineering in that space for enabling further growth of the PMS industry. Let me move on to how we are trying to expand the investment horizon. So as the Indian economy diversifies, the investment ecosystem must also evolve. Investors should have more choices as we mature. So we introduced specialized investment fund framework, SIF framework, and that is just one example in the MF space. And this instrument seeks to bridge the space between traditional mutual funds and portfolio management services by enabling more specialized investment strategies, of course, within a regulated environment. The SIF framework is showing good traction. Today, the funds mobilized under SIF stand at 11,000 odd crore as of March 31, 2026, and number of new schemes are being launched in this space. Similarly, we've also taken a recent regulatory measure expanding participation in instruments such as REITs, real estate investment trusts, by reclassifying REITs as equity instruments for the purpose of investment by mutual funds. This is again aimed at broadening the investment universe available to investors. Let me now move to some very recent measures which are work in progress but at an advanced stage. So 2-3 items there. One is the gift cards or the gift prepaid payment instruments for investment in mutual funds. So we issued a consultation paper in March for usage of gift cards, gift PPI, as a PPI is prepaid payment instrument, as an additional mode for investing in mutual funds. The idea, simply put, is that if I'm going to attend somebody's wedding reception, somebody very close to me, can I give him a gift of mutual fund gift card? So that is, simply put, that's the thought. So this proposal will enable gifting of mutual fund units through a gift PPI. Each of such PPI having value not exceeding INR 10,000, which are governed under the RBI norms. Certain safeguards have been proposed for this product, including funding of PPI only via electronic bank transfer, via UPI, 1-year validity with refund if unclaimed, limit of INR 50,000 per AMC per financial year, etc. The feedback has been broadly positive, and SEBI is in process of issuing suitable instructions or intimation to AMFI in this regard. So this is one new development. Second, again, fairly recent development, which is still a work in progress, is enabling third-party payments in mutual funds. So here we are trying to conceptualize some well-defined scenarios where we can allow third-party payments. The current framework requires all payments for investment in mutual funds to originate from the investor's own bank account. And the third-party payments are restricted for good reasons. Based on industry representation and also as an ease of doing business measure, we have recently initiated consultation. This is still at the consultation stage on allowing payment of salary in mutual fund units by employers. It could be listed companies, it could be EPFO registered companies, payment of commission in mutual fund units by AMCs to mutual fund distributors. Thirdly, also contribution or donation towards a social cause through mutual funds, either directly to an NGO or through social stock exchange. The idea is that if I am investing in, let's say, a fixed income instrument, and I would like to donate 25% of the interest income which the instrument will generate to be automatically credited to a social cause, I should be able to do it. In fact, HDFC Cancer Fund is a good example. Generally, we don't name schemes, but I think here there's no harm in recognizing some good work done there. So the HDFC Cancer Fund had a fixed income scheme where the investor had a choice to donate part of his returns to Indian Cancer Society. So just to illustrate, so idea here is, can we connect the mutual funds with social stock exchange? In social stock exchange, you have zero coupon, zero principal instruments which are listed, which are issued by NGOs. And can I authorize, if I am an investor in a mutual fund scheme, part of my returns can go to ZCZP on the social stock exchange. AMCs shall be required to put safeguards for ensuring investor protection and AML, CFT compliance under PMLA. This shall help to broaden the reach of mutual funds and encourage wider participation in capital markets. So very quickly, I'm mindful of time. Couple of key enablers is the third part of my address for orderly growth, governance and conduct. They are very important as we grow in size and complexity. So strong internal controls, effective governance, robust surveillance frameworks, and clear accountability mechanisms are critical for a good growth. Responsible distribution in mutual funds are to become the backbone of long-term household wealth creation. Participation must expand to smaller towns, newer investor segments, women investors, and first-time market participants. So recognizing all of this, we have accordingly adopted a very calibrated incentive framework for incentives beyond 30 cities for, we call it B30 location incentives, additional incentives for onboarding new women investors, and the introduction of the Choti SIP framework to support responsible expansion. The small ticket SIP, which often represent the first formal step into capital markets in many households, have shown good traction lately, which was not the case earlier. As of March 31, 2026, around 61 lakh micro SIPs, that is up to INR 250, have been registered with AUM of around 1400 crores. At the same time, we need to be mindful that retail-oriented mutual funds, especially low-ticket SIPs, are a very delicate product considering the target segment of the investor population. So responsible distribution, mechanisms to guard against mis-selling, and improving the ability of the target investors to appreciate related risks. That is a part of our investor education drive. All these things will be crucial. Very quickly, technology is an important enabler. That's another dimension for enhancing scale and conversion. Aadhaar-enabled KYC, mobile-based investing, and online execution platforms and seamless payment systems have all reduced friction in onboarding and execution of transactions. We also launched last year a platform called Mitra, MITRA, which can help investors identify inactive or unclaimed mutual fund investments. In case you onboarded, let's say 20 years ago, and you don't remember what was the name, what was the address you put in, what was the email ID you put in. So you can go to this platform and check if you have any investments which are in your name and you may have forgotten about it due to lapse of time or whatever reasons. So this helps locate the unclaimed funds, unclaimed units. Technology is also playing a key role in supervision. AI-driven supervisory tools and alert-based monitoring mechanisms. We are deploying all of this. They are enhancing our supervisory capabilities in areas such as digital advertisements, mis-selling risks, and intermediary oversight. At the same time, technology is also bringing in new risks. Cybersecurity, resilience, and data protection are now key business risks and central to investor protection. A related point is the need for firms to communicate responsibly about the use of AI. Exaggerated claims or selective disclosures can mislead investors and erode trust. Last point, and then I'll conclude, the stewardship. Why I'm mentioning about stewardship? Because this doesn't get much talked about, but it's a very important part as the markets grow. So domestic institutional investors, to put it simply, what do we mean by stewardship? The idea here is mutual funds are, their investments are growing. They are important stakeholders, shareholder in the companies. Can they play active role in improving the governance of the companies where they invest? That's the simple idea there. So DIIs led by mutual funds have now surpassed the ownership share of FPIs in the NSE listed universe. At the end of the quarter ended March 2026, the share of domestic mutual funds in NSE listed companies was at a new high of 11.4%. The rising ownership trend places mutual funds in a position to play an active role in ensuring better corporate governance of listed companies. SEBI already has a stewardship code. It is a principle-based stewardship code for mutual funds and AIFs with respect to their investments in listed companies. One of the aspects of the code is having mechanism for intervention in investee companies, including collaboration with other investors. In order to facilitate the industry to effectively discharge their stewardship duties, SEBI is exploring with AMFI the possibility of having a common platform or a common facility which can help mutual funds to come together and act promptly in the interest of shareholders. Such collective action can potentially enable mutual funds to discharge their stewardship role better. Let me conclude by saying that deep, efficient, and trusted capital markets together with responsible financial intermediation will be key to meeting India's economic aspiration, and that's a theme for this summit as well. The fund management industry has grown significantly, and the opportunities ahead are vast. All stakeholders must keep in mind that the ultimate objective is not merely more products, more clients, or more transactions. It is better outcomes for investors, for enterprises, and for the economy. Thank you for very patient hearing. Thank you.
Thank you so much, sir, for your thoughtful deliberation. I think the audience has really enjoyed and understood the nuances. I'd now like to call upon Sri Venkat N. Charasani, CEO, Association of Mutual Funds of India, AMFI, to kindly deliver his address.
Respected Shri Amarjit Singh, whole-time member SEBI, my senior colleague in State Bank of India, respected very senior colleague, Sri Atanu Senji, Chairman, National Expert Committee of BFSI, Sri Shashi Krishnan, Director NISM, Dr. Rajiv, my colleagues from the industry, ladies and gentlemen, good morning to all of you. At the outset, let me congratulate ICC on the remarkable milestone of completing 100 years of service to the trade, nation. The industry, they've done a lot of job, a lot of support to the industry. And I wish the chamber a continued success and greater accomplishments in the years ahead. All the very best, sir. It's a privilege for me to be here. Thank you very much for making me a part of this particular 18th session on the capital markets. It's a great to be here because like last time when I mentioned, it's all for me, this is the place where I started off my career as a dealer in a foreign exchange. For that, I started off my career in the treasury operations, and therefore it's always nice for me to be back at this place. The global growth we're talking about, I think Atanu Sen sir had already spoken about it, and we're looking at the pace at which the economy is growing. It's growing around 3.2 to 2.8 to 3.2%. But when it comes to the Indian economy, we have heard Reserve Bank of India talking that it's likely to grow at 6.7% for the financial year 25-26. And they're expecting the Indian economy to grow at a pace of around 7.6% for 26-27, despite all the headwinds that we're looking at, be it the energy prices, be it the global geopolitical tensions, because the confidence is emanating from the consumer, from the demographic dividend, from various stable government and various other positive factors that are there in our economy. So basis that, we are expecting the growth to be around 7.6%. But an aspiration to grow at 8.2%, which is a theme here, that's a scale at which the India would like to grow, and it's a national imperative. And when I heard that you're targeting 8.2%, I was wondering, what are the things that are required to change in order to ensure that from the way back from 7.6%, we can grow at 8.2%, and then achieve the dream of becoming a Viksit Bharat. So I'll try to move in that particular direction as to how to do that, and then see where the AMFI and Association of Mutual Funds and our total industry is supporting to move towards the achieving the target of 8.2%. One of the important discussions that we used to have when I was in the banking sector, when we talked about the growth of the GDP, we used to say as a thumb rule, we used to say that has to be a credit growth of approximately 1.5 to 2%. So if you're looking at an 8.2% credit growth, GDP growth, you need to have an economy as a credit growth of approximately around 20%. But that's not a thumb rule. It depends, varies between economies to economies. We have seen China growing at a faster pace when the credit growth happening on par with the GDP growth, but still they could reach the developed status. So there is nothing like thumb rule that it has to be on this phase. But for the credit growth to happen, there is a need for us to look at the household savings. That is something which is extremely important. And as we speak now, the retail household savings is approximately around 27 to 28% of the total GDP. One of the best savers in the world, I mean, as we speak now. But then, out of this 27% of the GDP, the household savings that we have, we were looking at how much of it goes into the physical assets and how much is going into the financial assets. In 2020, there was a great shift. We have seen that the financial savings have improved to around 34%, and the physical savings was to be around 66%. But then again, as we speak now, the physical assets, which are like in the form of gold, in form of real estate, in the form, they have started growing up towards 70%, and the financial savings have slightly gone down from 34 to 30%. But having said that, if you look at the composition within the financial saving, we are finding that people are moving from the banking deposits, or even for that matter, cash holding, towards the other growth assets, like what you look at, mutual funds or insurance for that matter, or the pension funds and provident funds. We find that the share of these things going up, and that is much reflected in what we are seeing as we speak now. To this extent, what AMFI or the industry has done, if you starting from with the blessings of the SEBI, from 2017, we started a campaign, what we called as Mutual Fund SAI campaign. Prior to that, everyone used to think that yes, for valid reasons, they used to think that mutual funds are subject to market risk, they are extremely volatile, and therefore it is only for the product for the high end, and very few people used to start investing. It is only for product for HNIs or for the corporates. After this campaign has started in 2017, at least the perception has changed from the clear mutual funds are subject to market risk to mutual funds SAI. And everyone understood the various jargon was very, very simplified, and people started understanding what these products are, and they started moving investing. And it has become a household product. Majority of the people, as we move across the country, what I see is, instead of people knowing what mutual fund is, many of the people know what SIP is. That's the way in which the product has become extremely popular. And it is reflected in the numbers which Mr. Atan Hussain did speak about, and even the SEBI World Time member had spoken about. The numbers have grown from almost around 14 lakh crores in 2017 to 18 to, as we speak now, the assets under management has grown to 82 lakh crores. There is an increase in the number of unique investors. There are a lot of development happened, be it in the form of number of AMCs. The number of AMCs have grown as we speak now to 55. The number of unique investors are around 6 crores. The SIP flows are around 32,000 crores. Quite a good numbers, all these speak to as we speak now. We have changed the way in which we are reaching out to the people. It's not just that we do only mutual fund SAI digital campaign. While that is the most successful campaign across the globe, we started moving slightly. We are supplementing that with various other things like recently we have started participating in the cultural get-togethers of like Kumbh Mela or even Rath Yatra in Puri. We have participated in Onam festival. Across various other things that we have done, we have created something what we call it Bharat Nivesh Yatra, where a bus which was explaining about the various mutual fund products has went across the country to various places and explained about what mutual fund products are and what financialization is all about. In addition to that, we have conducted some quiz contest, essay contest for the Bharat Young Minds. We have created more than 5 lakh people have participated because we strongly believe that youngsters, if they understand about the financial products, they understand about the SIP, they are the future of the country, and they would be in a position to understand and move towards the financialization that we're looking for. In addition to this Bharat Nivesh Yatra, Bharat essay competition, we also did something what we call as the Bharat Nivesh Run, where we added the health and also the investor awareness together and conducted this Bharat Nivesh Run across major cities to enable that the people understand about the financialization. All these things have resulted in great success to us. Of course, as you speak now, there is a movement, but then it's only the scratching of the surface. I mean, what we speak today, we have only 18% of the GDP is in the form of assets under management. Whereas in the developed world, it is more than 100%. If you look at the even the average, global average is around 65%. So for us, for moving from today's 18 to 20% of the GDP to 65%, there is a long ask. And SEBI, under the guidance of SEBI, various measures are being taken, which whole-time member had spoken about. But let me tell you something, while on the production side, sir, you did speak about and what measures have been taken, how the assets management companies are required to do it. But on the campaign side, let me move a bit. While there was a survey that was done by SEBI last year, and they found that more than 65% of the population knew about the mutual fund product, but only 7% of the people are investing into it. There is a huge gap between the awareness and action. Because of this, now this year, I mean, we started reaching out to the people, and one of the things that which is very, very close to my heart, and of course what under the guidance of SEBI we are doing is, we have adopted certain states. We started doing intensive financial education in those areas. We have entered into tie-up with marquee institutions like XIMB, Bhubaneswar. We have entered into tie-up with IIM Shillong, IIM Bodh Gaya, IIM Visakhapatnam, and of course with various other institutions in order to ensure that the teachers of the way of those particular states are trained, and they in turn go back to the villages, colleges, schools in the various districts and train the people and make them financially literate. Because ultimately, while we take pride that our literacy in our country is more than 80%, but when it comes to financial literacy, it is only 27%. We need to increase this financial literacy. We need to ensure that more and more people understand about the product. We are looking at doing regional programs rather than doing it in one language. We are just reaching out to every nook and corner of the country to ensure that the people do understand the products. The other important thing that we know that the most important arm for us, for the industry, is the distributors. Distributors are one of the most important arm, and they are the ones we are conducting knowledge series to them. We are conducting training programs to them. And under your guidance, sir, we are starting off with NISM, in collaboration with NISM. We have come out with the case studies, which we're going to start off for those people and train them to see to it that mis-selling, which you mentioned, would not happen. And for the first time, an ethical case studies are going to be given to them and ensure that people do because the industry is growing at a faster pace. And one thing which is non-negotiable for us, all of us, is a trust. Trust and ethics is something which is non-negotiable. We all want to ensure that there is, because the person at the corner of the country is investing in mutual funds, and we want to restore and keep the trust of the people who is investing in the money. So trust, transparency again, as a whole-time member did speak about, we are one of the people who continuously disclose about various things, and trust me, be it NAV, be it fact sheet, be it portfolio disclosure, be it anything that you want about the mutual fund investments that is happening, you as an investor do get to know. So our objective, while we are doing everything on the production side, come out with the new products, be it in the form of SIF, which the whole-time member did speak about, enabling the third-party payments, enabling with all the proper guardrails. We want to ensure that the investors do understand what financial goals are, what products are suitable to them, And that's where we are focusing upon, and we want to ensure that the last mile is also achieved and people start investing into this particular space. And people do understand the risk and take the things forward. So to conclude, for me, the 8.2% GDP growth trajectory is not just an economic milestone. It can be achieved. It can be achieved as we move forward, the moment we convert some of the physical savings into financial savings. And those financial savings is put to work in the form of equity or debt, passed it on to the people who are producing and innovating, manufacturing, and in turn, ensure that the growth of the economy happens. So 8.2% growth trajectory is not just going to be a dream, it is quite achievable. It represents jobs for our youth, infrastructure for our future, innovation for our industries, and decisive step towards a Viksit Bharat. The mutual fund industry is no longer on the periphery of the journey. I'm very confident it is a part of the core engine that is powering it. By transforming India's disciplined saving culture into productive financial capital, which we all are looking forward to do that, we are strengthening the credit backbone of the economy. We are lowering the cost of capital. It's going to be cheap capital that is going to be available to the people because of the reducing the disintermediation that is happening and enabling a sustainable and inclusive growth. If you do this well, India's growth will not only be high, it will be stable, self-sustaining, and widely shared. And as we stand at this inflection point, which Mr. Atan Hussain had just speak about in our national journey, I am reminded of a timeless thought, which says that the future belongs to those who prepare it today. Let us prepare India today for a Viksit Bharat tomorrow. Thank you. God bless all of you.
Thank you so much, sir. I'd just like to add on to your deliberation. Sir, Indian Chamber of Commerce with 15 national offices will be very happy to be a part of this awareness campaign or whatever you are doing, because we do the same thing with PFRDA. So, sir, let's meet one day and let's discuss how we can collaborate and work in a much closer fashion. Thank you, sir. And now I'd like to request Sri Shashi Krishnan, Director, National Institute of Securities Market, NISM, to kindly deliver his address.
Morning, Mr. Amarjit Singh Venkat, Mr. Atan Hussain, Dr. Ranjit Singh. Thank you so much to ICC for inviting me to speak over here. And we've heard, a lot of positive news, all the good numbers. But I think right at the beginning, Mr. Sen, posed a very, pertinent question. What and who will shape the Indian financial ecosystem? So today we have access. So access is no longer a problem. Literally anybody, anywhere in this country can access capital market products. Today, products is not a problem because, as Mr. Amarjit Singh said, you have mutual funds, you have SIFs, you have PMS, you have alternate investment funds. But in spite of all that, India's participation in financial assets, remains structurally low, relative to its savings pool. And I think even relating to its demographic profile, it remains structurally low. And I think the only way we can widen access, we can build trust, we can shift household savings from where they are into long-term wealth products can be through getting more and more involved professional financial advisors. And I think most of you people in this room are professional financial advisors, and I thought I'd touch upon that a little bit because Today the view from the top is breathtaking. You heard all the numbers, right? India is poised to become the fourth largest economy in the world. If somebody said third largest economy in the world. Our nominal GDP is $4.5 trillion US dollars. That's a staggering 400 lakh crores if you look at it in Indian rupees. But there is a more sobering microeconomic reality. And that microeconomic reality is that the per capita income of India is still around 2.5 lakhs. That's around 3,000 US dollars. And the Indian household seems to be caught in a paradox of wealth without growth. And if you look at that 30 crore, Indian households that we have, who are contributing something like 18% to GDP, I think that's the household savings rate, not the gross domestic savings rate. Where does that money go? I mean, a very tiny sliver of that money actually comes into financial products. And I think that is why the role of a financial advisor becomes that much more important, because if we do not close this gap, we will not get to that 8.1%. And that's, I think, the reality we must all face too. And if you look at the sheer scale of this, physical asset trap, which Venkat was talking about, Indians collectively hold something like 30,000 to 35,000 tons of gold today. And at today's price of gold, wherever it is, that's something like 500 lakh crores of rupees. And then we talked about real estate holdings. And the total real estate holdings that Indians have today, something like 500 lakh crores. So between gold and, real estate and physical assets, we hold something like 1,000 lakh crores of assets. And this is typically idle capital. It does not go to build factories. It does not go to fund startups. It does not create jobs. What it does is it gives you a huge amount of emotional comfort, no doubt about it, but zero economic velocity. And if we want to move all this capital into productive use, I think it is very important that, professional financial advisors, step into the arena. Look at the financial side of the ledger. And, a little bit was talked about some RBI numbers. But if you look at the RBI bulletin for January 2026, it says that out of the 353 lakh crores that Indian households have, close to 153 lakh crores is still in fixed deposits. How much ever has moved into financial assets, mutual funds, etc. And a whopping something like 35 lakh crores still sits as currency and cash in the cupboards of Indian households. And if you need to move that money into capital market assets, I think you need financial advisors. And therefore, we often hear about this retail revolution, Demat accounts are now 21 crores. The sobering reality is that you have 21 crore Demat accounts, but you have only 4.5 crore accounts that are actually active. You hear about, something like 26 crore mutual fund folios, but just about, 6 crore, folios are actually active. And again, if you want to move more of these 26 crore people into actually opening out new accounts, you need the financial advisor. And therefore, I think you cannot underemphasize the fact that the missing piece in this entire ecosystem is the financial advisor. And this participation gap, I think, can only be solved if you get in the financial advisor into the loop. And, we need to solve for this problem of trust, which, everybody has been talking about. And you go to any sort of seminar on financialization of the Indian economy, and people talk about this trust factor. I want to touch upon this trust factor a little later, because I think that's very important, and it's a very sort of difficult concept to understand. So there are a lot of numbers that were, sort of that starkly hit us when SEBI did its, SEBI Investor Survey 2025, which says that even though 63% of the Indian households, were aware of at least one security market product, it forgot about the remaining 37%, because then 37% were just not, aware of any securities market, and that's 11 crore households. Similarly, if you look at awareness itself, the kind of awareness that people have for, say, fixed deposits is something like 98%. You shift to mutual funds, the awareness drops to something like 53%. You shift to listed equity, it is only around 49%. So on a relative basis, there is still a lot of, low awareness levels as far as financial market products are concerned. And that's again where, the financial advisor needs to come in. Similarly, if you look at, salaried employees, 81% of them seem to understand what, financial markets are all about, what various capital market products are all about. But the moment you shift away from them, you shift to, say, agricultural labor, or you shift to the informal sector, that number drops from, from 80% to 49%. So obviously there is a gap. But I think the most stark observation from the SEBI Investor Survey was that awareness does not ensure adoption. And among those 21.3 crore Indian households that, were aware of these products, just about 3.21 crore households actually invested in these products. So awareness is one thing, and a lot of us are in the business of creating awareness. But how do we translate this awareness into adoption? And that's again where, the professional financial advisor comes into play. So we talked about the B30, and we said that, the numbers have been increasing. 18-19% of MF AUM now comes from, the B30. But even there, the knowledge gap is very huge. The survey actually went on to actually tell us that even among, those 47% of the people who admit to investing in the securities market, most of them claimed that they still had very low awareness. In fact, many of those people who are even investing in mutual funds or listed equity today, from an awareness level, are still not really up there. And therefore, I think the question that we need to ask ourselves is, why is it that 90% of Indian households are not investing into, capital market products? And I think the barriers that are there for these 90%, are very clear. First of all, without doubt, nearly every one of them finds these products complex and confusing. It is, very easy to say, कि mutual funds are here, but 90% of the people don't seem to understand what that mutual fund product is still. And that's where I think the financial professional comes in today. Similarly, I think there is an information overload today. And, there are multiplicity of choices. You have 55 asset management companies. Each of these asset management companies have got over 50 funds. How does somebody navigate that space? They need some hand-holding over there. And that, I think, is where, this participation gap, has to be bridged. Similarly, by nature, all of us are, at least we Indians are afraid of volatility. We do believe that investing into, equity or investing into corporate bonds will erode our principal, will erode our capital, that, there will be uncertainty in returns. And we therefore need to build a bridge between, those people who don't understand the markets, find it very difficult to reconcile themselves to this volatility. And that bridge can only be built by, a financial advisor. And, we keep saying that one of the big things that a financial advisor will need to do is to build trust. And I think I wanted to just touch upon this concept of trust, because it's a very difficult concept to understand. 40 years ago, when I began my career, I used to work with, one of the doyens of the mutual fund industry, Mr. A.P. Kurian, who was also, at Amphi at some point of time. And I posed this question to him, and he told him, UTI is nothing but trust between you and I. So it takes two people to, build up this entire ecosystem of trust. And believe me, 40 years ago, I didn't understand what this actually meant. Till a few years later, another, person who I worked with very closely, Mr. M.M. Kapoor, told me that दो चीज में आपको कभी राय नहीं देना चाहिए, एक तो शादी के मामले में और दूसरे इन्वेस्टमेंट के मामले में, क्योंकि यदि आपका राय सही निकला तो nobody is going to give you credit for it, but यदि आपका राय गलत निकला तो everybody is going to haul you up for it, which got me thinking about this whole thing, saying that, I mean, at the end of the day, as Mr. Amarjit Singh rightly said, it is about outcomes. And unless the financial advisor and the customer both own up to these outcomes, you can never build trust. And I was talking to the students of my, certificate course in financial planning that we run. And I told them that, financial advisors are typically held to one of these two standards. The first standard is a suitability standard. And the second standard is a fiduciary standard. Suitability basically is saying that this financial product is good enough for you because somebody who is your age, somebody who is your income, somebody who is your gender, will find this product good for him. But believe me, what is suitable for you may not be the best product for you. And that is where we need to hold ourselves to a higher standard, and that is a fiduciary standard. Where what we are going to say is that, not only is this product appropriate for you, but this is the best product for you. And, I am putting my client's interest right above everything else. And that is where trust starts getting built up. And I think that's one of the very important things that we must realize as, financial distributors, as financial advisors, that the only way you can build trust with your customer is by being a fiduciary. We were talking about the fact that, they need advice. But, you'll be surprised to note that almost 56% of the people we surveyed in the SEBI Investors survey, turned to the social media and turn to, finfluencers for their advice. And I think it begs a question as to why is young India so much more comfortable going to, information available in the digital ecospace rather than going to a financial advisor. And I think the answer stares us straight in the face. One is simply because it is easier to access the internet than an advisor. One is there aren't enough advisors, and even if there are advisors, it's very difficult to access that advisor, whereas it's very easy to access the internet. You can do that sitting at your home. And the second, I think, more important thing is that people are not very sure whether, it is actually adding any value, because what a financial advisor will do is advise you on a product. He doesn't advise you on anything more than that. And that's something you can get off the net. So why at all should I go to a financial advisor? In fact, the numbers itself are very, very worrying, because there are only 1,016 SEBI registered investment advisors. There are only 3,534 certified financial planners in this country, right? And even if you look at the mutual fund distributors, which Venkat was talking about, I think there are just about 1.75 lakh registered individual, advisors for a population of 150 crores. So there's a long way to go. First of all, you just can't find that advisor. And even if you find the advisor, you don't even know whether he's adding any value. And therefore, I think if you need to sort of improve this ecosystem, we really need to sort of build up this entire advisory ecosystem. And I just want to take a few minutes to talk about 4 or 5 instances where this makes a very, very big difference. We were talking about the SIPs and the fact that, SIPs haven't been discontinued in this recent volatility. Believe me, AMFI themselves have put up data of the discontinuations of SIPs. And if you map that, which we have done from a research perspective, to volatility in the markets, we find that every time there is volatility in the markets, close to around 45% of SIPs, newly opened SIPs, tend to get discontinued. And that, believe me, is not a product problem. That is basically an advisory failure. Because the real time you need an advisor is when you have this volatility in the market. Look at life insurance the life insurance space. Life insurance penetration anyway in India is very, very low. It's just around 3.2%. And there also, you find that the lapsation rates are very, very high. So I think there is a huge amount of value that financial advisor can add in terms of simplifying the complex, breaking that metro-centric approach that most of us have in terms of financial advice, building trust, building solutions for the informal sector. And I think that's where, we all need to put our collective ideas and thinking today and try and find out how can we get solutions for that. Thank you so much for your time.
Thank you, sir. I'd now like to request Dr. Rajiv Singh. Okay, any questions for our speakers? We can just take one or two. Can you please introduce and then ask your question?
Hello. Hello.
Yeah, please go ahead. It's working.
Good afternoon, everyone. I'm Sanskriti Purohit. And at the outset, I'd like to congratulate ICC on bringing together prolific speakers on one stage. It's truly an honor to have all of them here. Sir, my question is to the Honorable Whole-Time Member of SEBI. One word I think was common in all the speakers' speech was to build trust in the investors. So to reach to an 8.2% GDP and the kind of trust we need to build in investors, but what we've been seeing as market manipulation or the geopolitical scenario, the way finfluencers have also been mentioned. So if you can throw some light on how the regulator is approaching this market manipulation and how they're building trust, not just on the demographic dividend, but also the geopolitical dividend, also the market manipulation and the orders that have been coming out. So if you can please throw some light on that. Thank you.
Yeah, thanks for, am I audible? Yeah.
Yeah.
So thanks for asking that question. That is our daily work, daily job, to maintain trust of investors and other stakeholders in the securities market. So there are two dimensions to it. One is you learn from, the episodes in the market and you come up with a policy fix so that the same thing doesn't happen again. You fix the cause of a crisis or cause of a problem or cause of a misconduct, fix at the policy level. So that is learning from what goes on. Part B is acting proactively in consultation with the industry as a part of a risk management exercise, that whatever the potential loopholes could be, how do we fix those? Just to illustrate that with some concrete example, for example, we've asked AMCs, asset management companies, to deal with potential misconduct at the AMC level and put a very structured system in place. And that system has actually been co-created by industry and SEBI together. So there are various ways of doing it, but whatever you may do, I'm not saying that just for India, in any market, there is still, some fraud may still happen. And that you have to deal with through enforcement measures. You have to take action, you have to take appropriate action as per the seriousness of the violation that you find out. So it's a continuous game. But my sense is that we've not seen any major market-wide crisis, and touch wood, I mean, we don't want to see it for many, many years. And thanks to the effective oversight and the regulatory regime that we put together.
Thank you, sir.
There's one more.
Okay, last question, please.
I'm Shreyansh Seksaria, and sir, I have a question to Shashish sir. So you talked about influencers, and now I come across like my investors sending me reels that some of the influencers are saying that क्या आपने ये scheme में देखा जिसमें 20% returns है, and when I tell that those returns have been in the past and it's not representative in the future, and I say you should stick to like a nominal return, and that would be beneficial for the to set the right expectation. But they still feel कि नहीं यार उसको सुनने में अच्छा लग रहा है तो उसका return भी अच्छा होगा. They like to hear what they want to hear, but they don't want to hear what is correct. So this is creating a major gap, and people are focusing on the short-term wealth and not focusing on the real part. So how can we fix this thing?
I can't talk to you about influencers, but I think this is a fundamental behavioral problem, because there are only two emotions that drive, anybody's financial behavior, and that is greed and fear, right? And I think the big effort has to be how do we, change behavior, and what is it that we need to do to ensure that people are more rational in their decision making. It's not easy. It doesn't happen in any market. In every market, there is irrationality. But what you'll need to do is you'll need to keep educating them to the extent that they become a lot more rational than they were in the past, and are able to overcome some of these behavioral biases. I don't think the problem lies only with the influencers. It also lies with the fact that as humans, we are wired to be driven by greed and fear. And one of the big efforts that everybody in the financial industry, including SEBI, including AMFI, including we at NISM, is to push financial education to see that, investors get better outcomes by better behavior.
If I can just add, to the previous question. So, if you think of what could be the metric, what could be the benchmark to say that the investors are trusting the market players or the market systems. So one would think maybe the rising number of investors, and that data I talked about. And also once you've joined the market, once you come to the market, are you staying on? So what is the longevity of your investment? That data also I mentioned. So I think on those parameters, you have to have some reasonable concrete benchmark, right? And those numbers also show that the people are trusting the market. Thank you.
Thank you. I'd now like to request Dr. Rajiv Singh to kindly propose a vote of thanks.
So I think we had a very engaging inaugural session. Of course, the regulator added his own point of view in terms of what government is doing, how they are steering the entire capital market, keeping it transparent, reliable, trust-based, and also keeping pace with the changing times. So we are truly grateful to our special guest, Mr. Singh. Thank you for kindly agreeing to be with us. Of course, you rightly hinted that Saturday morning, of course, the hall looks much better now. And what I can assure you is that Calcutta definitely keeps pace with the capital markets. It may not be very flamboyant or visible, but there is a lot which happens, and the investors here are quite well informed, and I'm sure the message will reach to the people who are not in this room. We are equally thankful to the CEO Mr. Chalsani of AMFI for bringing in his perspective, how AMFI looks at the mutual fund market. Equally thankful to Mr. Krishnan, Director of NISM, for bringing in the reality check. He highlighted some of the hard-hitting facts, and of course, the need for having advisors and bridging the gap. Broadly, my take is that India has huge aspirations. Prime Minister had set a very ambitious target of 5 trillion economy, and we are talking about becoming a developed country. So I think the money which is there in the country, people, that has to be channeled to productive uses, of course, to the market. But at the same time, we have to keep the investors' interest in mind, because if investors don't have trust, if investors don't have right kind of experience, I think this whole exercise will only go up to a point. So everybody has spoken of trust, but at the same time, trust is a very complex term. There are a lot of things which have to be addressed, which have to be addressed on a continuous basis, because these are changing markets. Geopolitically, things change every day, and going ahead, things are going to become much more complex. So with this, I'm sure you all enjoyed the deliberations. During the day, we have some very eminent experts from the industry. I'm sure you are going to love their deliberations. So with this, I once again thank all our esteemed guests on the dais, of course, participants, all our sponsors, and the speakers who will be addressing us during the day. Thank you so much.
Thank you, Dr. Singh. I now request Dr. Singh to kindly felicitate our esteemed speakers, starting with Sri Amarjit Singh, whole-time member, SEBI. Now may I request Dr. Singh to kindly felicitate Mr. Chalasani, CEO of AMFI. Mr. Shashi Krishnan to kindly come forward and request Dr. Singh to felicitate him. Chairman, BFSI Committee Chairman, Mr. Atanu Sen to kindly come forward and request Dr. Singh to felicitate him also. I request for a group photograph of this session. And we are not breaking for tea, coffee, because we started pretty late. So we'll immediately move after this group photograph. We'll immediately move with the next session. It's going to be a very interesting session. I'll request everyone to be kindly seated, because post lunch sharp at 2 o'clock we have a session with Sri Nilesh Shah, and he is hard pressed for time. So if we give this break, then your lunch time is going to get shortened. So we'll continue like this. And thank you so much, gentlemen, for your presence and time. Okay, so I have got a very interesting panel session. I can call it a CEO panel session also. It's called the Anchor Session, Steering India to 7 Trillion Economy. So, can we have the changeover very fast? So I'd like to call upon stage firstly the moderator of this session, Mr. Anindo Palchoduri, founder, Wealth Family Office and Group CEO, Wealth Group of Companies. Welcome, Anindo. I'd now like to call Mr. Anand Radhakrishnan, MD and CEO, Sundaram Mutual Fund. Thank you, sir. Mr. Avinash Satwalekar, President, Franklin Templeton Asset Management India Private Limited. Welcome, sir. Mr. Ashish Somaya, MD and CEO, White Oak Capital. Mr. Raghav Iyengar, CEO, 361 AMC. And Mr. Varun Gupta, CEO, Grow Mutual Fund. So, welcome everyone, and I now request Anindo to take this panel forward.
Hello. Very good afternoon, everyone. I'm kind of at a hot seat, sitting with 5 eminent CEOs, and we are running about 35 minutes late. So, and we have 4 segments of the panel, and there are 5 speakers. So I don't want to rush because very rarely Kolkata get to hear 5 eminent CEOs from the mutual fund industry. So I'll come straight to the topic. I mean, we are talking about a number which is $7 trillion, which is like $2.15 trillion surge from the existing number of 4.85 trillion. And, you know, this doesn't mean simply building a speed, but at a speed which many mid-sized economies also envy. The mutual fund industry currently holds about 80 lakh crore AUM, which is roughly about 8x from where we were about a decade back. We have about 31,000 crore SIPs coming, you know, without any friction, without any tension, without any extra action. We have about 27.5 crore folios to testify a penetration, again, which many countries envy. But the hard question is our industry's ambition matching its assets? Demographic window is something we have a huge benefit. But what we need now is a strategic doctrine, a clear, deliberate philosophy, how institutional capital partners can contribute to the national progress. So I'm joined by 5 eminent speakers, Ashish, Avinash, Varun, Anand and Raghav. And they are not just merely observe the system, they actually are the system, because their combined AUM is a meaningful fraction of whatever we decide today. So we move to the first section, the first segment of this panel. It's called MF Evolution from Retail Savings to Strategic Capital. For years, mutual fund was like a FD plus, beat the inflation, get a decent return, retire safely. So that has built an industry. From there, the role has completely changed in 2022 when FI has pulled out a lot of money and domestic investors stepped in. So I'll start with Anand. Anand, my question is, when your fund sits where retail money meets institutional deployment. So when a 500 rupees SIP from a Bhopal school teacher ends up funding an infra bond or a core sector stock, that's national impact. So is this shift something you plan in your philosophy, or is it just the scale at work?
Thanks, Anindya. The role of capital market is to efficiently allocate capital. And by efficiently, what I understand is to sectors which have great prospects of growth, which have the ability to earn returns which are greater than cost of capital. And this keeps changing over time. So that makes capital markets very dynamic and very fluid in that sense, but over a period of time, it becomes a very efficient allocator of capital. So to that extent, I would say it is in the very design of vehicles like mutual funds to channelize savings or investments to the most efficient or faster growing segments of the market. It also brings with it the great responsibility in a fiduciary sense that we don't wager that capital excessively towards speculative purposes, which may look like high yielding short-term returns, but don't serve the longer-term interests of the country or a nation or the market per se. So to that extent, I think that fiduciary thing is what makes mutual fund a very interesting vehicle where we are aligned to the national growth as well.
Great. So moving to Avi. Avi, we have seen a surge of thematic and sector funds, manufacturing, infra, PSU, defense. Some say this is a very smart backing of India's growth. And some say it's momentum and marketing, nothing else. So according to you, what is closer to the truth? And does it mean MFs are shaping the economy?
Sure, thanks, Anindya. I think there's no one single way of looking at it, right? There are different aspects. Anand talked about mutual funds being an extremely productive, or I would say efficient vehicle to promote growth and support that growth. But another way to look at it is that it is probably one of the most efficient methods of participating that an investor has. And how you participate is what's critical, right? There's no right or wrong, whether there should be more thematics, whether those are just momentum driven. There's a different approach each investor needs to have, right? If you have the capability and you have the understanding to go into different sectors and you want to focus your efforts in those sectors or your investments in those sectors, by all means, you should be doing that. But if it is based on a fad or something that is being driven by a short-term interest, right, then those typically don't end well. And for the average investor, I think having a broad, diversified equity portfolio achieves most of those objectives. It is only for the select few that do want to be far more actively involved in it, where I think thematics do make a difference, right? There's no, like I said, there is no right or wrong, and there's no one single truth to it. But I think as we look at trying to get to that 8.2% GDP growth, as an industry, the focus should be around how do we expand and penetrate the participation. More because that, like I said, mutual funds are the most efficient way for an Indian citizen to participate in the growth. So if we're true believers in that 8.2%, how do you participate in that? And I think having a broader diversified equity participation is much more effective.
So it's the intent towards the execution.
Absolutely.
Ashish, global funds like Korea's NPS, Norway's GPFG, Singapore's GICs, they back a lot of national interest without compromising on the discipline or the regulatory work. In India, we don't have such a sovereign structure which can, help the cause. So do you think Indian AMCs, on their own or together, set a clear framework to back capital goods in priority sector? Or does that risk crossing a line that could hurt investors' confidence and trust?
Yeah, see, I think because mutual fund industry is like one of the preferred vehicle for people to meet their financial goals and to plan their, financials, wealth creation, etc. So I think from that perspective, trying to direct it towards any national priority, nationals, like you said, national strategy or priority sector, it runs the risk of compromising what would actually serve investors in their own personal finance, right? See, for example, one of the key things is that we run different mutual fund schemes, and by regulation, each of those has a underlying benchmark, correct? So our first port of call, let's say if we are running a flexi cap fund, our first fiduciary responsibility is to beat the BSE 500 index, correct? And the BSE 500 index itself has a certain composition in terms of its sectors and factors at play and, all of those. So if you ask me, we are very focused on constructing a portfolio which on a relative basis can beat BSE 500. So you can say that we are slightly, blinkered in our perspective, or, you can say tunnel visioned when it comes to having a certain priority or a certain focus. So from that perspective, we have to manage money for that. On the other hand, yes, I do get your point, which is that should we have sovereign wealth fund kind of structure which gives the national priorities? But then you should also keep in mind that most of these sovereign wealth funds, they invest globally. They are not necessarily just funding
their own countries.
Generally by nature, they are generally not funding their own countries' infrastructure. We have for infrastructure and all of those things, we do have separate vehicles which the government has created. The government has even created venture funds to push certain sectors. So government and quasi-government institutions are doing in some way what you are suggesting, but maybe mutual funds best if they are kept out of those kinds of agenda.
Got it. A very, very clear answer, no. Okay. Moving to Raghav. Raghav, SIPs work because they are automatic and happens, in spite of any activities in the market, though we heard that for some 45% data that it gets stops. But, India's push to 7 trillion economy is not just from a steady flow of SIPs, but smarter direction. Are SIPs the right tool for that job? Or do you need to have new products, designs, which can guide the India's growth of the economy?
So thank you very much. Before I start that answer, I just want to make a small statement. So as I was coming to Calcutta, my nephew said, "Hey, you're going to," I said, "What are you doing there?" I said, "I'm going to attend the ICC summit." So he said, "It's the International Cricket Council. That means you're going to meet Jay Shah." I said, no, there's another Shah coming along the way. That's not Jay Shah. So thank you very much for getting me here. So I hope in the next few years, ICC gets as popular as the international ICC. But yeah, coming back to your question, I think the important thing that your statement made, and everyone keeps talking about it, is that the SIP story is possibly India's greatest financialization effort. It's in fact the most successful. It's happened largely because it's simple, it's automatic, and it's very easy to communicate, and more importantly, very easily regulated. It's really democratized the whole capital market structure for India, right? Literally, like all the panelists have said, that you have a 500 rupees SIP coming from Bhopal. Impossible to think of when we started our lives 25 years back. I mean, it was very complex. I can get into a dialogue about all the nonsense that we used to do in SIPs in those days, but it's really made life easy. People like Grow have really contributed to that. But coming to your important question, I think if we have to get to this 8%, we have to get to certain sectors which are critical: defense, aerospace, renewables. Those are not things that are unfortunately listed in the capital markets in a meaningful way today. You get access to it, and 361 does a lot of products, but they unfortunately or fortunately cater to the HNI, UHNI segment through AIFs and PMS. In fact, we're just launching our renewables franchise in the next couple of months. So we have a credit franchisee, we have a private equity franchise, but that all sits at possibly India's top 20,000 families. It doesn't go to the next case. So I have a suggestion maybe that at the same time, like Ashish said, we are all blinkered. We have our goals, we have our regulations, we have our guardrails. We can't just go off on a whim and decide to do something. We are here to primarily serve one person, which is our investor, right? And do what's exactly right for him. In that sense, it sounds selfish. The nation comes second. It's the investor first, right? But the investor is the nation. So in some sense, they're related. So I just think that maybe we should figure out a way to try and get at least our capital infrastructure story a little more deeper. A long time back when I started my career, these bonds were very popular, India infrastructure bonds. You know, they used to actually go and contribute a lot to things like this. So maybe today we have that in a form of InvITs and REITs. Yeah, are they easily accessible? No. The best way to do it is through a SIP. It's a tried, tested mechanism. Maybe we could do something there. And then maybe have a sleeve around thematics to really do the interesting core stuff in a mutual fund structure, but not as a fad. Because I think the worry that I have is because having spent so much time here and lost so much hair in this industry, I don't want to make the same mistakes again. You know, launching a tech fund in 2000 and infra fund in 2005, all that nonsense, the industry fortunately has stopped, and that's where we are today. So if we can get a combination of these two, Anindya, I think that will be an interesting point. Yeah.
So Raghav, just to inform you, Indian Chamber of Commerce, we are celebrating our centenary year.
Correct, yeah.
And this was started by Sri B.K. Birlaji.
Wow.
And so last year when we had hosted Mr. Kumar Mangalam Birla, he said that it feels like coming home.
Yep.
And we do have our rep offices in more than 20 countries and multiple Indian cities, and we do host multiple global events. We just concluded one where 800 delegates from 20 countries attended in Geo, and we are going to have one at Taj Palace in September. So
yes, more power to you, more money to you. May you get as much of money as the ICC.
yes.
May you have many Shahs over here, right?
Yeah, because I think we should be more
you
popular.
made my
than...
surname into Chinese, by the way. I'm Raghav Liangar here, so I became Chinese here. So okay, I think that can get corrected. So I don't know if you're telling me something, I'm not sure.
Taking a cue from Raghav Varun, my next question to you. You know, your digital platform has done wonders. I mean, today, Grow is a name I don't think anybody is not aware. Okay, but you have enabled a lot of retail money seamlessly flowing into the system. But does that help, the national priorities? Does it help getting more money for sectors like manufacturing, energy conservation, or you need to tweak your strategy, you need to educate your customers more towards that?
Sure. First of all, thank you, and there's so much for inviting us and giving me a chance to interact with all you esteemed people. Quick journey about me. Like, so I have been a distributor before then. We got acquired at Grow, and we have been building Grow as a platform. And you talked about we made it very big, and now looking after the AMC part. So taking cues, your question is largely about Grow, so I'll focus there. See, when we started, in 2018, what we realized that there is I came from a distributor background, but there is a large population of Indians who were who didn't have access to advisors. And, Sri Shashi Krishnan ji, he talked about that there are only 1.75 lakh ARNs, only 1,000 RIAs. So there were like a lot of people in India, the long tail of Indians who wanted to do a 500 rupees SIP or 1,000 rupees SIP, and they didn't have access to advisors. And that is why these platforms became, the platforms like Grow became very big, because they provided a very, very simple way for people to start investing in mutual funds. But what has happened over this period of time is that from 2015 to 2026, if you look at it, our industry has become 6x. We had 1 crore investors, we now have 6 crore investors. We were sitting at 5 lakh folios, 5 crore folios. Now we are sitting as 25 crore folios. And what has happened because of this is there is multiple customer segments which have emerged. Earlier, if I remember when I was a advisor, like there used to be very simple, there is a core portfolio, then there was no concept of a satellite portfolio. You will largely keep money in your diversified equity fund. Sometimes you will take a hybrid fund. Hybrid fund was a very emerging category then, it was not even popular. But now what has happened is that because of the awareness and because many new customers have come without the hand-holding of advisors, there is a lot more understanding, there is a lot more awareness and a lot more risk-taking which is happening in the market. Broadly we talk about now because you talked about few sectors, there are 2 segments of customers, 2 segments of investors we look at. One investor which has become very mature over a period of time, started investing early, have created sufficient net worth, understand the concept of core portfolio, but also want to dabble in satellite portfolio. And they would take exposure to some thematic funds, some sectoral funds, where they believe there is a long-term decadal growth opportunity. And we believe that smart advisors across India have also started advising their clients on this fund. Then there is second category of investors, which are, very long tail, putting in a small amount. They are unfortunately chasing returns. And when you look at returns, there will always be one or the other sectors which will outperform, right? So they are chasing returns and they will put money there. Now, what has happened because of all this is that what we have started realizing that in online platforms, and the reason we as a group got into AMC is that in 2021, we realized that digitally, while a lot of people will come and start investing, but it is very difficult for them to create long-term wealth. And all these numbers which we are seeing that SIP has cancelled 45%, 50% in a month. What we are seeing is this large part of this SIP cancellation is happening online because the capital is not patient, right? That capital will become patient only when it is being advised by someone. That's why we got into this business. The whole idea was to enable the advisors, to get them to basically help customers create wealth over a long term. Now, what we are seeing that organically, some of this money is flowing into sectors which are India's important sector and which will, which gives also an opportunity to investors to create wealth over long-term period. And, Raghav mentioned a very important point, right? Like, we are all investor first, right? And, while it is not very easy to say, but we all want to be investor first. The only way our business continues to run is that our investors create wealth. So we look forward to creating those opportunity. We are very positive on power T&D as a sector, very positive on defense as a sector in the long term, very positive on railways as a sector. And we are seeing that advisors are also waking up to the fact that there should be some allocation to this while the core portfolio remains in the diversified equity. And also investors are realizing on their own and talking to their advisors that whether they should allocate in this or not. So I wouldn't say that, as a focused way, we are diverting the capital into these sectors, but organically this movement has started happening.
Okay, great. So we move to the next segment, which is regulatory harmonization, domestic rules versus global investor expectation. SEBI's 2017 category framework was a big step forward. It cleaned up messy universe of schemes, set TER caps, added riskometer, tightened disclosures. On paper and in practice, India's MF rulebook is among the strongest in the emerging markets. Yet many global LPs and EM allocators still say that 2 things hold them back are policy surprises and uneven disclosures. Trillions flows through EM mandates each year, but India doesn't get enough what as a strong economy they should deserve. So on that note, my first question to Avi, you speak to both domestic and global LPs. When a sovereign fund or a large allocator asks you, why is India under-owned in EM portfolios? What's your straight answer? Is it rules? Is it disclosures? Is it taxation? Is it market access? Or simply old narratives which need to be amended?
So let's break this down. You're right. We do spend enough time talking to global investors as well as domestic investors. Foreign investors, I know recently there's been a big outflow and there's n number of reasons why those outflows have occurred. And whenever these outflows occurs, then you bring up issues like, okay, well, is it regulations? Is it our taxations? Is it policies, et cetera, right? At the end of the day, foreign investors, or any investor for that matter, is looking at maximizing their returns. If India provides disproportionate return potential, India gets flows. If India does not provide those disproportionate return potential, the flows go elsewhere. It's quite honestly simply as that. Now, can we make it easier, right? And that is that's a constantly evolving process, right? And I would say that most of our rules and regulations are relatively straightforward. Are there areas that we can improve? Most definitely. Are there areas like taxation that we need to harmonize compared to most of the larger financial hubs? Absolutely. When you talked about the fact that India is under-owned, India is under-owned today. In 2024, India was 21% of the emerging market index. So it had more than doubled its allocation, right? Today it stands at about 12%. So when you're saying India is when it is over-owned, under-owned, it's a function of what the underlying economic factors are. Nobody is going to come into India as an investor because all of a sudden our regulations are better, right? Do those help facilitate flows? Absolutely. But at the core, we need to see earnings growth in our economy, in our companies. That's what drives flows. I do think that these are really good times and opportunities to revisit a lot of the things. So, for example, on the taxes, there are a number of areas where we have a relatively higher tax structure than any of those other foreign countries, including emerging markets like Brazil and China. So when you compare ourselves to that, how do we reduce the friction for flows to come in and how do you encourage that? It's a great time to look at it. But that in and of itself is not going to drive flows. The flows are going to be driven fundamentally by the belief in economic growth, the sustainability of our economic growth, and how our corporates are able to take advantage of that. And part of the reason why foreign flows have been leaving the country is not because all of a sudden our policies have been erratic or our policies are not stable. It is because we have not been able to provide the earnings growth fundamental compared to what, let's say, a China is able to do, or a Korea is able to do, or a Taiwan. So those have been the issues, but I do think it's always good, and I think that's one of the key things with all our regulators, whether it is SEBI, whether it is RBI, they're constantly evolving, and if there is a real sticking pain point, those have been addressed. And I think it's never done. There's always more to be done. But I do think that we are moved quite a bit, and I feel that most of that sovereign wealth fund interaction is more around where is that relative opportunity when it comes to an investment.
So it's return, not the process.
It's both, but the primary driver is always return. I always feel that the primary driver is going to be return because September 2024, when we were getting all those massive flows, we had the same rules and regulations, the same taxation. Nobody was complaining about it then. So what is the issue right now, right? So it is a balance of that, and we have to constantly improve and evolve.
So just one anecdote that, these 5 gentlemen, they are CEOs of their firms. Not for any other reason, because of their intellect. In case you have noted, Raghav led me to my next question to Varun, and now Avi led me to my next question to Ashish. That is, on paper, we have a solid framework. But in practice, where do global investors still feel the friction? Is it KYC, onboarding, documentation standards, valuation policies, timelines? Can you give me 2 fixes which would lower their risk premium without diluting SEBI's guardrails?
Sure. So, one is, now look at the practicality. I'll just build on what Avi mentioned. Like we run a lot of these funds which are domiciled in Dublin and, like global funds investing into India and even global funds, like even Franklin runs, global funds investing all over emerging markets. Now see the practical implication of what he cited. Let's say the MSCI Emerging Markets Index has 27 countries. So for a moment, just say that we are investing in 27 countries. Now, these are open-ended mutual fund schemes, right? See what will happen. In 26 countries, there is no tax. In one country, there is tax. So now think, Avi is smiling, think what it does to calculate NAV when you know that you have 12 to 15% exposure in a country where every transaction is going to be taxed. And it's an open-ended fund declaring NAV every day. So people can enter and exit any day, which means that an investor who came 1 year back, okay, or any day an investor has come, whatever my portfolio positions are, I have to have an assumption of how much is long-term gain, how much is potentially short-term gain, make provisions in the NAV every day, right? For one country. For 26 countries, there is no tax, there is no provisioning in the NAV. If you don't make those provisions, then 12 to 15% of your portfolio valuation is going for a toss, because when you sell those securities, you're not going to sell them at the price at which you are doing the NAV. When you sell the securities, there will be a tax. So you're not going to realize what you're actually calculating. So there has to be a provision in the NAV, that's a debit, correct? So now imagine that for a fund which is declaring NAV every day for 27 countries in different time zones, and there is some guy whose full-time job is to
calculate the tax.
Make sure that your provisioning is correct and nobody walks out with a higher or lower, right? So it's crazy. It's not about you wanting to earn tax revenue. Look at the sheer magnitude of
complexities
and the complications, right? So that is one thing you should keep in mind. Second thing is, now in India, for example, I'm very, very happy that from an asset management company's perspective, I'm very happy we have we are a young firm, we have 1.2 million unique PANs. And you know that we do KYC of every customer. So theoretically, while all customers are sourced through fintechs and intermediaries and wealth managers and distributors, the fact is that we have done KYC on every customer. So the customer data resides with us, right? So onshore in India, very happy about it. But now, one of the gateways to bring money to India is GIFT City. So what is happening? The Indian rules we are applying in GIFT City. World over, it doesn't work that way. World over, there is something called a quasi-nominee system. You will also know, Shoibal will know, Raghav will know. It was there in India 20 years back. If Shoibal invested in my fund, it would say Shoibal Ghosh, care of HSBC, right? And HSBC makes one payment to me, sends me data for all customers with the undertaking that if there is any inquiry related to taxation or anti-money laundering or anything, he will provide me the customer's data. Now, for Indian rules, it's fine. But when we want to raise money in GIFT City, then in GIFT City, we cannot, GIFT City technically is not India. GIFT City technically is a global jurisdiction. Yeah, it is near Ahmedabad, that's fine, but it's not India.
Yeah, absolutely.
Right? Visualize it as an island in the middle of the sea.
Correct.
So they are not supposed to copy Indian rules. They are supposed to copy rules that apply in Switzerland or DIFC or Singapore or Luxembourg or Dublin or wherever. There, it is still a quasi-nominee system. They don't do KYC of every customer. So today, theoretically, if I go to HSBC Geneva and say that you gave me $5 million, tell me who all have invested. They will not give. You can't do that. So what happens is that time and again, our regulators are time and again asking the global investors to give a list of all the underlying identifiable, constituents of every fund. Because we want that KYC and so many things. And I don't think it's for wrong reasons. I'm just saying that because we're talking about friction, I'm just saying that we need to align with the global practices.
Could be simplified.
Yeah, see, we don't have a choice because we have to align with global practices. The reason is because the global fund centers are Luxembourg, Dublin, Singapore, Dubai, all of these. And we are a new entity trying to establish ourselves. So we will have to follow those practices and
Right.
align with it, right? So that's the whole point.
Right. Thanks, Ashish. I move to Raghav now. Raghav, global LPs, they love predictability, right? So India's pace of circulars, clarifications can feel fast from outside. What would a no surprise playbook look like? Advanced consulting windows, phased rollouts, or sandboxing before full adoption. How do we keep the agility while giving global money to a steadier runway?
It's a superb question. And, we again, at 361, we manage some large institutional accounts. So we have some experience in this. I don't think and I think one thing I like to make in this room very, very clear that, because we call them LPs, right? Limited partners, but anyone who's a 10-year LP, to my mind, it should be treated like a scarce natural resource. He's a critical mineral in our system, basically, right? So we should make sure that they are absolutely fine because they are very rare in the world today. Getting a 10-year commitment as an LP today, whether it's a retail customer or HNI or an institutional customer. I don't think when we meet our offshore guys, I don't think they're stressed about the number of circulars. I think as a domestic AMC, we used to get very frightened of Fridays because every Friday evening one circular will pop. Not too long ago, fortunately, that's gone off a bit right now. And I think that way SEBI is sort of really up the curve there. I think they're really sort of revamping the right stuff like Honorable WTA mentioned that they're completely revamping the MF and the other things. So I think what the global guy wants is readable regulations. I won't say predictable because I don't think you can be predictable as long as Donald Trump is around. So I think something will constantly change. But I think they want readable regulations. And I think more importantly, they want a framework by which, and I think SEBI has done that. I mean, if you see the last couple of circulars, on the GIFT, on the third-party payments. They've put a consultant paper out. So give a 90-day window for all participants to comment. Obviously, take those comments into account, which they do. Number two, if there's something very significant, put a 12 to 24-month implementation window, which, by the way, is already happening. And lastly, of course, I think most importantly, keep it as tight as possible. And agility is required not at the time of regulation. Agility is required at the point of infraction. So if there's a problem, let's say if they discover an anomaly, some problem which is breaking the regulation, I think that's where agility is required. And those are things which, frankly, global investors are very comfortable with. So I think the regulation part is in some sense quite sorted. I think, like Avi rightly mentioned, we are possibly losing money not for any of those purposes.
But for returns.
I think I think there is a cycle to everything, and I think we are not in the right cycle at this point of time. But given the efforts of all the people in this room, I don't think it's a crisis because that 35,000 crores of money comes every month. It's been a great way to sort of counter it, if I may use it. And obviously, at some point of time, when the cycle turns, and they will come back.
Yeah, I completely agree. I mean, it's a journey. I mean, it's not a crisis. And in Indian journey, there are bumpy roads and then there are smooth roads.
Yeah, but ET and money control and everybody likes that word. So unfortunately, that's the word that gets mentioned.
Yeah, I mean, we, so Raghav, we tell our clients that, stay away from ET, CNBC.
I didn't say that, okay.
And
Don't put me in a spot over there.
So my next question to Anand. Anand, index weight drives flows. If India's fundamental weight is rising, but index weights lags, who should lead the conversation? The industry, the exchanges, or the policymakers? And what is the smartest way to close the gap? Push for methodology, tweaks, deepen free floats, or improve foreign ownership access?
It's a very complex question. Just to kind of explain the audience, India's share of global GDP was in the 90s used to be 1.5%. Today it is possibly around 3.5% or so. Whereas India's share of global indices, less like MSCI All Country Index, it's somewhere between 1.8 to 2%. So our weight in the index is roughly half or 60% of our economic weight in the global GDP contribution. One of the main factors they use is something called a free float factor. India typically has less free float factor versus other countries because most of the equities in India is owned by the promoters or entrepreneurs. Sometimes the entrepreneurs include government as well. On an average, promoters and entrepreneurs own close to 60% of the market. Only 40% of the market is genuinely floating. Within that, of course, big institutions like LIC and MFs have now become part of that free float as technically no longer floating either. So our weight, therefore, is less than our potential weight. Now, one of the biggest problem is at the time of going public, as per regulations, every company needs to float a minimum of 25% of their capital. And there are exemptions regularly provided to that. Exemptions can be if you're greater than 4,000 crore market cap at the time of listing, you have to only float 10% of your company, and rest you can gradually float over a period of 3 years, 5% each. I think this exemption needs to go. Then SEBI needs to strictly say that every company needs to float 25%. Now, the problem is liquidity available to support that kind of float, especially if big companies like Grow get listed. I think they are one of the exempted ones, right? So big companies like Grow get listed. They can't float 25% easily because that would require raising 25,000 crore if it is the 1 lakh crore market cap company or something like that. So there is always these exemptions given, and this exemption has become a very large proportion. And I think that needs to be clearly handled. If it warrants a lesser valuation for the first 25% of the shares, I think companies should be willing to do it. So it's where partly that people who are trying to access public market, they should be willing to pay that cost. The second issue about having this less float is control. Most promoters and entrepreneurs want to control their business, and they think that the more the percentage they own, the better is the control. Whereas regulatorily, if you own 26% or 51%, it is good enough. If you have a good governing board, if you have fairly good governance standards, and having control over the business should be easily manageable. But because of the way where we have journeyed over the last many decades, having very high percentage ownership is seen as the best proxy for establishing control over the businesses that you have. And this leads to this unwanted offshoot of having a very low float. So to that extent, I think companies have to evolve in their thinking and be happy with lesser percentage, but better value in the marketplace, more institutional investors as a part of your journey, and more access to global capital. These things can create new vectors of growth for any companies. So it is control versus access to better capital. You have to make a clear choice. And it's a tough choice. It's not easy. I mean, where most of the Indian promoters' wealth is staying in their own companies. So if you're asking them to literally forego that wealth a little bit, so it is a very tough choice. But I think we have to collectively make that move forward.
Wonderful. I mean, this question was purposely kept for you, Anand, because you are perhaps one of the most seasoned, CXOs we have today. So, Varun, my question, taking a cue from the last one, I mean, you started with a, online retail portal where you get lots and lots of retail money. Then you moved to an AMC. Now, tell me, for let's say 2026-27 financial year, what is that one change you wish to bring in your product or an investor education, which can lead the inflows into more priority sectors and countries' growth?
So I have a different question than the panel, basically. So and what I'll do, so I don't look at Grow anymore, so I don't know,
No, let's talk about the AMC only.
Yeah. So from a AMC perspective, our continuous objective is to educate investors, work with the distributors to be able to cater to this new age of investors, right? So what we have seen is, as I was mentioning in my last answer, that the number of investors have increased very drastically, and these are very different behavior, right? They are significantly more aware, significantly more. And they learn a lot of different things. You will have to make them unlearn first, and that is how you manage. And also you have to be digital first. So we are also enabling our MFDs to become digital first. So largely these are the two segment of customers we look at, MFDs and customers, right? Sorry, I want to skip the question and move to the question from a FII perspective, which you were asking, because we have raised money in our AMC from one of the largest foreign institutional investor, State Street, right? And we are continuously in touch with them to understand when are they coming back. Like that is the question which everyone is asking in India. So in their global CIO words, this is what we have understood. And the narrative has completely changed in the last 6 to 12 months, right? Just 12 months back, by 2024, everyone was positive on India because there was huge consumption. People could see that there was growth happening and money was chasing India, and all of a sudden the whole trend has dropped. So this, from people who are actually doing it, practically what they have told us is, see, global money basically chases trends, right? While it's very smart money, but it chases where the next phase of growth is going to be. The next phase of growth undoubtedly is AI across the world, right? And that money is moved and has moved into AI in different scenarios. In the last 6 quarters before Q4 FY26, all of this money was getting deployed across AI. The global run which we were seeing was happening because of AI. But they were the second thing which was also hampering for FIIs to come back to India was this, the reduced corporate growth, right? Corporate earnings growth. They were waiting for the corporate earnings growth to come back, which actually came back in Q4 of FY26, right? The corporate earnings growth was 14.8%, which is actually very high. So this, see what happens is that this FIIs will deploy largely in AI. They will not go 100%. So about 40% deployment in AI has already happened. Now this money is actually waiting to come back to EM and largely in India. But because of the macro sentiments, I would call it a luck or how things have happened, but because of the macro sentiment, this money could not find its way into India, right? While it was waiting on the lines. So the understanding is with the inflationary scenario, which we are going to see with the rise in oil prices, the corporate earnings will slow down for this year. And our internal estimates are also that we will probably be able to do a very low double digit kind of a growth between 9 to 10% this year, which will possibly not be able to attract FIIs till we cross like a 14-15% kind of a mark, which is expected from an emerging market. So this is, so FIIs are waiting, while the money has been deployed largely into AI driven themes and, whatever, like in the whole AI supply chain. But we are confident that once all the deployment is done, when the corporate earnings are back, when the macro environment goes down, FIIs will come back. We are not seeing that happening, at least in this FY or earlier part of this FY. Mostly it can happen in later part of this FY or early next FY.
Thanks, Varun. It was really appreciated. I mean, you gave a very even number-centric projection. So we are at the halfway through of our discussion. We move to the next theme, which is currently the most pertinent, I guess. It is macro stability, geopolitics, trade, and valuations. We are actually living through a reset in the global order. Supply chains are shifting, trade is being used as a policy, capital routes are being redrawn. India is on a strong spot. I mean, we are much stronger than many peers, but better than peers does not mean that we are insulated. So on that note, my first question of this segment to Ashish: when geopolitics jolts prices, before fundamentals move. What's your first line of defense? Is it sizing, cash, hedge, or factor tilts? Give me one rule you use in real time to counter this.
Sure. So, I'll refer, continue with the reference of, the first question that you asked. I had made it clear that at least as far as we are concerned, we are managing these portfolios actively, but with a clear thought process to beat the underlying benchmark. Correct? So let me put it this way, that when it comes to the portfolio construction strategy, we are not benchmark agnostic, and definitely we are not the benchmark. So I would say we are benchmark aware. Correct? So we are informed by what is there in the benchmark, but we are neither agnostic nor are we really tracking the benchmark. What it means is that at any point in time, when we construct our portfolio, if you leave it to us, if you leave it to our analysts, they'll make a portfolio of companies which will be, ROIC over cost of capital, free cash flows, secular growth, good quality governance, all of those. But we need to be mindful of the fact that the benchmark has companies with good governance and not so good governance. Benchmark has companies which are defensive and cyclical, right? So benchmark has everything. Benchmark doesn't have any beliefs or any religion. So which means that whenever we construct our portfolio, we will have to keep testing that whatever portfolio we're constructing, what is our deviation from the benchmark? If we construct a portfolio as per our liking, but it ends up being completely disjointed from what the underlying benchmark is, then either we will have a very high positive alpha or a very high negative alpha. We don't want any of those extremes. We want good information ratio, we want good consistency. So what will happen is that at any point in time, we are making a portfolio which is benchmark aware. So as far as sectors, factors, and even the cash allocation. So we'll not have cash. Our sector allocation will have a controlled deviation from benchmark, and our factor allocation will also have controlled deviation from benchmark. But the portfolio constituents will be very different from the benchmark. So the portfolio is 55 to 60 or 65% active in certain cases, but sectors, factors, cash, all of that is matched or close to the benchmark, right? Which means that out of all the things that you said, the only thing that will change for us will be within the sectors. What is the sizing of stocks? Sectors versus benchmark. What is the range of underweights and overweights? So that is what will change, right? How much is the deviation from the benchmark? And within the allocation to a sector, what is the kind of sizing? Because we run portfolios which are very, very granular, right? So we want alpha, but we want alpha with consistency. So, and the last thing I'll tell you, it's very natural in today's environment to talk about macros. They are very important. But I'll tell you two things about macros. One is that macros are, so, when I'll make it very clear. Basically, you cannot predict macros. And what is even more difficult is how the market will react to macros. That is the reason why our strategy is the way it is, right? Now, whenever you tell someone that you can't predict macros, somehow they hear that macros are not important. I'm not saying that. Macros are very important. But can you predict the macro? Like, could somebody, as late as December 2019, people couldn't predict COVID, right? Now, take a last example. In Feb 2020, if somebody told you, देखो अभी COVID आएगा, market 40% गिरेगा, तुम लोग सब लोग घर में लॉक हो जाएगा और वो पैंडेमिक फिर एंडेमिक वो सब हो जाएगा. You would sell your whole portfolio, right? Correct? You would sell your whole portfolio, sit on cash. You will be happy for 3 to 6 months. By November 2020, market was making new highs. That's why I said you cannot forecast macros. Even if you forecast macros, you cannot forecast how market will react to those macros. So that is the reason why we don't try to forecast or take cash calls or make very big binary decisions. We are consistently being benchmark aware and tracking our deviation. And the active management is more at a stock picking level.
To ensure that you have a shock absorber.
Yeah, jo performance hai na, it should never be Jannat or Jahannam. It should be
That's
in a particular
wonderful acronym. So my next question to Avi. Avi, how do you tell the difference between a short-term shock or a regime change? what signal or threshold makes you pivot from ride it out or reposition?
Short-term shock versus regime change. I think regime change now is a fairly dangerous term to use, considering that is exactly what has been started in the Middle East and is not exactly gone in the direction that President Trump has at least wanted. How do you look at short-term shocks versus regime change in the markets, right? There's no one particular signal. And I think to borrow something that Ashish was talking about, your focus is on delivering consistency, right? And when you're looking at a short-term shock, the definition of that short-term shock, I mean, when you just take the most recent example with the West Asia, right? You're talking about what was supposed to be a 2-week skirmish, and here we are a couple of months into it, with not really a clear end in sight.
Correct.
So what would have theoretically started as a short-term shock is now you're recalibrating and looking at it saying that, is this now a shift? Now, these things don't happen overnight, right? You have to recalibrate constantly. If you're looking at, let's continue with this current example, are we now at a regime change in the markets, right? I do feel that the approach that all investors are taking now is going to dramatically change. And how is it going to change, right? Historically, we've always been focused on, okay, let's take a look at the macros of the economy. Let's look at the macros of an industry and then get down to the companies. We are bottom-up investors. What does that mean? We focus on what the company dynamics are first and foremost, because you can be in a bad sector, but still have a good company and a good investment. What has changed now in the last, I would say, 2 to 3 years is the whole idea around the blending between economics and politics. And that's happened at a global level. So there was a remote kind of academic subject, for the most part, called geoeconomics, right? Not very many people qualified in it, not very many people paid attention to it. Today, there are a lot more people focusing on it. And why is that? Because the entire global economic structure is changing, and what we used to think of as geopolitics, which was nations going to war with other nations, that was geographic, right? We have now changed that into economic. So economic trade is being weaponized, and therefore has an impact on every industry, every economy underlying. So now that is a regime change. But did that happen overnight? It started off as a shock. What was the first shock? Tariffs. Suddenly you started looking at, okay, what does this mean for all the industries? That was a short-term shock. Now that is now fundamentally how we all look at it. So a short-term shock can result in a regime change. And I think that's what we're seeing. And if you look at the landscape, take the investment landscape and take a step back and look at it right now. For the last 30 to 40 years, we have benefited from the whole idea of globalization. That has fundamentally changed. So global trade and globalization and the benefits that accrue to it are now going to be looked at very differently, which means our bilateral agreements, our regional agreements now take a lot more importance. So when we look at, let's say, the EU trade agreement, or when we look at the UK trade agreement, or with New Zealand, there is a lot more attention and importance now on that, because the assumption that you would have free moving goods is no longer an assumption that you're going to make, right? So that is a regime change. Now, is there any one indicator out there? No, there is no one indicator. It is what you're seeing, each individual change that occurs, and how that moves from either starts as a short-term shock, and does that have the ability then to move into this? So each one you have to analyze, but I mean, like I said, I've given you a couple of examples which started out as short-term shocks, and now we are looking at it as a regime change in terms of the approach.
Wonderful. Raghav, I mean, funds have a fiduciary responsibilities, but they can also steady markets, right? So where can MFs act as a stabilizers without taking on policy roles, and what limits do you set so that you don't overreach?
No, I think that's very visible today. I think the fact that so much of money is coming in SIPs is itself in some sense a sort of a stabilizer. If we had the kind of FI outflow without the proportionate amount of inflow, I think our indexes may have been much lower or may have been much more volatile. But yeah, so I think that's a big one for us. I think the SIP flow is a great stabilizer. I think what mutual funds, all of us bring to the table for the investor is some amount of valuation discipline. I think we tend to stay away from very expensive stocks, tend to put a lot of governance into decisions. So we improve the quality of decision making for the investor. So that's the valuation we bring in. I think the most important thing that we all do, at least here, is that communication. I think communicating to investors has been a very key part of the industry growth. And that sort of, we get better at it with every down cycle. So I think the way we communicated, say, for example, in 2000, when we had the dot-com crash, and where we are communicating, say, for example, in 2020, when we had the COVID crash, is a big sea change of difference, right? And obviously, a lot of things have come together, mutual funds, say, etc. But that's a very critical part of our business today. I think the one red line that we can't do is that, see, we have one fiduciary master. And as I said in my first question, we serve the investor. We cannot be seen to be serving two fiduciary masters. So we, at any point of time, mutual funds or like us cannot be a lender of last resort, irrespective of where the, whatever the situation is. So I think that's the big red line that I have. But everything else, Anindya, is fine. Yeah.
Wonderful. Anand, we are at a situation, crude is, $100 plus, there is tariff doing a bit of a havoc. So what changes first you intend to do in your process? Is it earning models? Is it risk limits? Or is it sector weights? One concrete shift which you haven't made before.
Yeah, it's again a very interesting question. Like it or not, we may have to take a call on what is going to happen, macro. If you're not going to take a call, I mean, this is slightly different from what Ashish was telling, but as a portfolio manager, we need to have a world view of what is going to happen. If there are two scenarios, one scenario, let us say that the current situation continues and oil remains sustainably at a higher level, rupee remains sustainably weak, then we are in for a higher interest rate regime, India-wise. So there can be rate hikes, there can be other interventions, which can lead to meaningful change in the current market disposition. And that should help, that should push us to make some changes. Currently, let us say we are less exposed to rate sensitives or more exposed to cyclical stocks, let me put it that way. If interest rates go up, there is quite a good possibility that some of these stocks may take a hit. If oil remains high, maybe the fiscal pressures are going to cut the government capex down. Maybe we need to make a change. So this is attendant decisions will have to come out of the worldview that oil will remain high. On the other hand, if you think that oil is going to come back to $60 where it was, some of the sectors that got impacted by high oil prices, including, let us say, banks. Banks were meaningfully sold down because high oil prices were seen as a harbinger of higher interest rates, and therefore banks were seen as rate-sensitive sector, and they all got hit. We may see a mean reversion kind of a trade in banks, especially the lending part of the financial services ecosystem. So we should be aware that we have to make these two hard choices, these kind of choices in our portfolio. It is one thing to say that one set of the market has become kind of reasonably good value, another segment of the market has become very expensive, and if you are a pure bottom-up person, you will probably gravitate towards the value end of the market as we speak. The value end of the market is where lending financial institutions, IT services, which got impacted by AI, etc., are available. The growth end of the market has defense, capital goods, power sector, AI trades, all kind of things are there. So the choice have to be very clear. So we are at the cusp, and it is very tough for a portfolio manager today to kind of make that hard choice. Some people are doing a little bit of barbell strategy, where you think you have this current exposure, which is existing growth, but you keep kind of allocating a little more towards the contrarian part of the market. And in case things ease off, you have a very good chance of bounce back. So, and there are more such things like, you can intervene at the sector level, you can intervene at the stock level, and be prepared if an eventuality like one of these two situations happens.
Wonderful. So, Varun, my question to you, last question in this segment. So you are a fairly new AMC, okay, and this kind of geopolitical or the external news many a times disrupt the fundamentals, right? So what is that one step your AMC is planning to take to ensure that your new customers are kind of not really scared or be slightly more risk averse so that the flow continues?
Sure. So see, as an AMC, there are largely two things which we do, right? Like we launch the right funds with the right strategy, and we communicate it well to our advisors, right? And to our end investors. So see, from a market point of view, our thought process is this, that we are, for the short term, at least for the foreseeable future, and just building up to what Anand was saying, we are going to be in a volatile scenario. There is going to be inflation risk. We are going to see corporate earnings probably slow down. So the broad beta strategy does not work anymore, right? If you are close to benchmark, or if you are like, giving a lot of importance to benchmark weights, it's probably will not be very practical in the short term. And this also comes back to, how investor behavior is changing. It's not, it's not just the indexing which the investor requires. So that is, so broad beta in our mind will not work. So from a from a short-term perspective at a index level, we are not seeing a lot of upside, at least when I say short-term, I'm talking about 1 year. But still, there are a lot of selective opportunities at sector level and at stock level, which are available in India, where there is a very structural long-term growth story, right? There are few sectors which Anand also pointed out. I will also say the same. There is defense, right? We are seeing no capex slowdown, which is happening from the government side. Then there is railways. Railways, while there is some slowdown, but all the long-term capex deployment keeps on happening. Then we are talking about, there are some AI data center companies, especially in the small and mid-cap space, which we are very, very excited about. Then there are some sectors where we are organic, which we are underweight. We are not even, at the index benchmark, and, only the time will tell. For example, IT, we yet to see what will happen. Large cap IT, largely, we yet to see how the AI revolution will play out in the IT services. There are some mid-cap IT stocks which we are very comfortable with, because we know that there is some movement towards AI which is happening, and it is yielding into their results. So yeah, that is broadly which we are doing, right? Like trying to launch the right funds for the investors, being very slow, not just launching funds right after another, and actively advising or actively discussing with our advisors to go more towards the active funds, instead of choosing the broad beta at this point in time.
Great. So we'll move to the last section, and I would request all the 4 speakers to be kindly little brief, because Avi has to catch a flight, and we are running quite largely behind schedule. So our theme of, theme 4, the last segment is institutional capital as a long-term partner for India. So as we look at 2047 Viksit Bharat dimension, the question is not really how fast India grows, but how strong our institutions become. Roads, ports, factories are one evidence of the visible growth. The quieter proof is how well we collect savings, we protect them and deploy them for the next generation. So on that, my first question to you, Anand, long-term projects need steady money and clear accountability. What would let mutual funds back longer duration opportunities, manufacturing, energy transition, urban infra, while staying fully inside in today's rules?
Channelizing the capital market flows into longer term opportunities is a very big challenge. It's not easy, especially in an industry which is built on medium term performance. I won't say short term performance, I would say medium term. So you need to deliver goods, if not in 1 year, but at least in 3 years. And that is the time horizon any investor is looking to evaluate your funds. So we are kind of hard pressed to trade off between short-term opportunities and long-term goals per se. But having said that, access to longer-term investing pool is very important. Like for example, the EPFO's allocation to market through listed equities, through index funds is one such thing. But it should, because it is limited to index funds, top 150 or top 100, the scope of play is very limited. And it is also limited to few players, which EPFO is currently kind of shortlisted. So our request is, is to kind of consider wider set of investing opportunities and directing the retirement pool of money towards such opportunities, because they have access to very long-term capital. So that is one thing. Second is what is the recent one development which SEBI has put in its website, which is access to payroll deductions kind of a thing, much like the 401k plans of the US, where the investor decides where they want to kind of channelize their retirement money, and not a government authority. If that power of that choice is given, then AMCs can make a marketing sales pitch to convince the employees of organization to at least part of their savings, and they can structure it towards slightly longer term goals.
Okay. Moving to Ashish. Ashish, this is one area which is a huge sore point for us distributors. Shoibal and Shoibalda both would agree. Good behavior compounds, churns destroys it. Okay. However, we have seen that with a long holding period, the distributors are at times penalized by reducing the brokerage. So what do you think should be a good practice which should encourage good behavior, long holding, without providing any penalties for the industry?
See, I think people are unable to have a long holding period, whenever they have emotional reactions to market events, right? Like greed and fear and envy, and all of these are emotional reactions. And it is well-known fact that people have emotional reactions when they are exposed to some kind of extreme. You make a lot more money than you thought, that's an extreme emotion. You underperform horribly or lose money, that is another emotion. My neighbor is making more money than me, that is another emotion. So basically, human beings cannot be emotionless. So the strategies and the programs that we run, they should kind of clip the emotion out. And that is where I think, products which have very extreme performances or portfolio strategies which result in very extreme performances, that should be avoided at all costs, right? Second is that hybrid funds are also a way to avoid extreme outcomes. Doing systematic investing is also a way to avoid extreme outcomes. Being contrarian in your thought process is also a way to avoid extreme outcomes. So whether it is asset managers, distributors, or investors, if we all can work hard, see, we cannot become emotionless. The only thing we can do is to invest in a way that we avoid extreme outcomes, because if we avoid extreme outcomes, we will avoid emotional reaction. And if we avoid emotional reaction, we'll not make mistakes, then we'll be long-term investors. That's the way to look at it.
Wonderful. I had a counter question, but since there is very little time, we'll run through.
We've been giving long answers deliberately.
So my question to Avi, trust is the foundation of a patient capital. What disclosure or reporting upgrade, simple, consistent, comparable, would most strengthen investors' trust over a 10-year horizon?
I think when we look at what we've got in terms of a rules framework and the disclosure framework that we have with SEBI, today, I don't think that there is a single market anywhere else that has the level of disclosure. Even within India, I do not think the mutual fund industry or the capital markets disclosure levels are worse off. They're probably the best compared to any other financial segment, even within India. So I don't think there's any additional disclosure that's going to improve the trust necessarily. I think what will improve trust is that, I think a whole time member, Mr. Singh also said this, that frauds are likely to occur. But the enforcement action that is taken has to make sure that that is a real true example of something where there is true genuine fraud that is occurring, right? That is how the trust builds in the system. I think there is plenty of trust in the system already. I mean, when you look at any financial product out there, mutual funds are the most transparent. There is not a single moment in time when you do not know where your money is, how you can access it, and what it is worth today. Right? So I don't think there is any additional disclosure requirements that are really going to improve that trust. The trust is going to come from where you see something going wrong, that is rectified and corrected and punished. That is how you get trust in the system. I think there we are doing a really, I would say, a very good job of it. And that's how inherently, I think that's why people, when they talk about mutual fund expanding and mutual fund sahi hai, the reason for that is there is an inherent trust in the system, and that has expanded. So I'm not saying that you need more additional. I think the view of having a longer term perspective is more around what you think that longer term perspective is going to generate, and how do you control anything that prevents you from being long term. And what prevents you from being long term is the emotional havoc that is caused in the market by constantly looking at the news flow. Right? I don't think any change in what happens tomorrow in West Asia is going to make a dramatic difference in your portfolio today. Right? It is like you were talking about earlier, short-term shock versus regime change. You need to focus on the regime changes if you are going to be a 10-year investor, because that is going to have a more dramatic impact. Rather than, I don't think there's any particular disclosure requirement that's going to change that.
Okay, Raghav and Varun, my sincere apologies. We have to, the last question, we have to skip because we have grossly over-exceeded the time. So,
just please compensate that sacrifice to Varun and me in the form of AUM. We'll take it. No problem. Huh? Yeah. Varun, that's okay, right? No problem. Yeah.
Thank you so much for being so kind. Ladies and gentlemen, these 5 gentlemen have come all the way from Bombay. They are CEOs of different mutual funds, and they deserve a thunderous round of applause for on a Saturday morning coming to Calcutta and spending so much time. Thank you. Thank you, Ashish. Thank you, Avi. Thank you, Varun. Thank you, Anand. Thank you, Raghav.
Thank you.
Anindo, I request you to kindly felicitate our speakers, starting with Mr. Anand Radhakrishnan, MD and CEO of Sundaram Mutual Fund. Mr. Avinash Satwalekar, MD, CEO, White Oak, Franklin Templeton Asset Management India Private Limited, President. Mr. Ashish Somaya, MD and CEO, White Oak AMC. Mr. Raghav Iyengar, CEO 361 AMC, and Mr. Varun Gupta, CEO Grow Mutual Fund. I'd like all the speakers and the moderator to kindly join us for a group photograph. Meanwhile, we are breaking for lunch. We'll have to come back sharp at 2 o'clock. There are 2 counters, buffet counters outside. One more thing, there you have got a lucky draw coupon. That lucky draw will be conducted at the end of the conference, and you will also collect your personalized gift from the Presto counter at the end of the conference. We are breaking for lunch. I am thankful to all the panelists and the moderator of this session, which was supposed to be there. We are shifting it post lunch.